So in this chapter 7, long-term assets, they start out with a discussion on a WorldCom, expenses called assets. Now, what do you know about expenses and assets? How are they similar and how are they different? Well, as far as recording journal entries, when you acquire an asset, you debit the asset account, right? The asset's increasing, you debit the asset account. So if you were to go out and purchase equipment, for example, you would debit equipment and credit cash or notes payable or accounts payable, something like that. By the same token, if you were to say pay your telephone bill, you would debit utilities expense, right, and credit cash or accounts payable. So how are assets and expenses similar? They both get recorded with debits. Now, how are they different? Well, assets belong on the balance sheet and expenses go on the income statement. So if you were a dishonest type person, for example, and you wanted to make it look like you had more income than you had, instead of debiting an expense, you debit an asset. And that's exactly what this company did, WorldCom. To make the company look more profitable than it was, they debited asset accounts instead of expense accounts. Net income was higher, earnings per share was higher, the stock price went higher, and people like this guy, who a lot of his compensation is tied into the stock price. You've heard of stock options, I'm sure, right? Stock options are a form of compensation where executives get shares of stock instead of a paycheck. But the shares of stock can be worth a lot more than the paycheck. So that's what this company did. They would debit assets instead of expenses to make the net income look higher so that he would get paid more. He's in jail, this guy. He's been in jail for a while, and he'll probably be in jail for the rest of his life, which is rare for white-collar crime. Yeah, he was 63 years old and sentenced to 25 years in jail. And he insisted that he knew nothing about it. Okay, well, then I guess he got screwed. What can I say? So let's take a look at a balance sheet, right? This is Darden Restaurants, which I think owns Olive Garden, if you've ever been to Olive Garden. So what does the balance sheet look like? Here's your current assets, if you'll remember, right? Cash, receivables, inventory. Those are the current assets. Those have a life of a year or less, right? And then we have the long-term assets, the property, plant, equipment, intangible assets. We're not really going to talk about intangible assets. Think of intangible assets as things like copyrights and trademarks, things of that nature. Now, notice they don't say anything about depreciation here, but these numbers are shown net of depreciation, right? So we'll see how that works. But property means land, plant means buildings, equipment is equipment. And as you know, equipment can take many different forms. It can be machines, it can be computers, it can be office products like fax machines and copiers, things of that nature, right? It could take very many different forms. So the challenge for us is where do we come up with these numbers? What goes into coming up with these numbers? Okay, now here. This is the first main topic we're going to talk about. Acquisitions. In other words, buying. these assets. Buying these assets. So here's the general rule. You know, the challenge for us is to know how much are we going to debit the account for? You know, if we're buying land, how much are we going to debit land for? If we're buying equipment, how much are we going to debit equipment for, et cetera? Where do we get that number? Look at this sentence here. This is the key. We record a long-term asset at its cost, right? In other words, how much did we pay to buy the asset? We record the long-term asset at its cost plus all expenditures necessary to get the asset ready for its intended use, right? The cost plus all expenditures necessary to get the asset ready for its use. So it's more than just the purchase price. It includes any additional amounts necessary to bring the asset to you and in the condition that's necessary for you to use it. Now, most of the time you buy the thing, you take it out of the box and you use it. But there are times when it's more complicated than that. So for example, think of buying a car. If you walk into a car dealership and you see the car sitting there and you like it, and you negotiate a price with the dealer, and let's say that comes out to be $20,000. The dealer says, okay, we'll sell you the car for $20,000. Does that mean that you're just going to pay $20,000 and drive the car away? No, right? You have to pay sales tax on the car. You usually have to pay an amount to get the car ready for you. In other words, the car could have been sitting in a lot and it's dirty and it needs to be cleaned and detailed and all of that. You pay for that. The car needs license plates. Otherwise, you can't drive the car away. And a registration. So the cost of all of those things is part of the cost of the car. So it's more than just the purchase price. It's the purchase price plus any other expenditure necessary to get the asset ready for use. In other words, you couldn't drive that car away without paying for those extra things. And again, you know, you say, well, is that an expense or is that an asset? It's usually part of the asset if it happens before you using the asset, right? So think of before use and after use. If something happens before use, that's part of the cost of the asset. If it happens after, it may be asset or it may be expense, right? You have to pay attention to that. So what about land? What goes into the cost of land? Right here, they give you examples right here in this paragraph. So when you buy land, you just don't pay for the land. You have to pay other costs. For example, you have to have a lawyer, so you have to pay the legal fees. Sometimes you pay a real estate agent's commission. You have to pay to have the land put in your name. That's title. That's what that means, right? Before you buy something like land, you have to search the title. In other words, you have to go back and look and see if the person that's selling you the land is really the person that owns the land to be able to sell it to you. Right? And usually you hire a company to do this for you, the title search. You don't do it yourself. In some states, the attorney does it, but in other states, you hire an outside company that specializes in this. Recording fees. right? If you have a mortgage, that has to be recorded in the county clerk's office. The deed with your name has to be recorded in the county clerk's office. The person that you bought the land from, if they had a mortgage, they have to pay to have a satisfaction of mortgage recorded at the county clerk's office. So that's what recording fees are. If the property is subject to back taxes or other obligations, we include these amounts as well. What does that mean? Well, if the person that you're buying the land from owed taxes on that land and didn't pay them, you are obligated to pay them. That's not tax expense. That becomes part of the cost of the land, right? Why? The word back, right? The word back means before use. Other obligations, if the person that's selling you the land had a mortgage on the land, and you're responsible to pay the mortgage, it becomes part of the cost of the land. If there's any other liens on the land and you're responsible to pay them, they become part of the cost of the land. Now, you negotiate that out of the selling price, okay? So it's not like you're counting it twice. Now, what about once you buy the land and if you wanted to put a building on there, you would have to make the land level. Or if there was already something on the land, a building, for example, you would have to knock that building down. So all of these costs, clearing, filling, leveling the land, or even removing an existing building on the land, all of this becomes part of the cost of the land. Now, sometimes what happens is if there's a building already on the land, right, before you knock it down, you take out of that building anything that's worth anything and you try to sell it. If you're able to do that, that's what they mean by here, selling salvaged building materials. You can reduce your cost by that amount. So sometimes in old buildings, there's copper pipes, for example, and copper is worth something. So you would have the copper pipes taken out of the building and you would try to sell them. And that would reduce your cost. So here they give you an example. This was Olive Garden. They buy some land, and on the land is an existing building. They paid $500,000. They want to knock down the building and construct a new restaurant on that land. In addition to this $500,000, they have to pay a sales commission of $30,000 to the real estate agent. And they have title costs of $3,000. They have to pay $8,000 in taxes, but here's where it gets confusing. $6,000 of the $8,000 are back taxes, and $2,000 are current. Now, when you see the word current, think expense. Back, think asset. Shortly after closing, the company pays a contractor $50,000 to tear down the building and remove it from the site. They are able to sell salvaged materials for $5,000. So how much did it really cost them to tear down the building? $50,000 minus 5, right, is $45,000. Plus they had to pay an additional $6,000 to level the land. You can't build something on land that's like, hilly or bumpy or whatever, right? If you want to build something on the land, you have to make it level first. So how much did this land really cost? In other words, how much am I going to debit the land account for? So here they take you through it. $500,000 I paid to buy the land and the building. I had to pay the agent $30,000. I had to pay $6,000 in back taxes, right? Back. $3,000 in title cost. $50,000 to tear down the old building. but I was able to sell stuff in the building for $5,000. So notice that's shown here as a subtraction because it's reducing the cost, plus $6,000 to level the land. The total cost of the land is $590,000. So if I was making a journal entry, I would debit land for $590,000. Now, maybe all these things didn't happen at once, so the total debits to land would wind up being $590,000, but these could be separate entries. Not all of these entries would be made at the same time. Notice that the $2,000 in taxes is an expense of the current period. Debit, tax, expense, credit, cash, right? Land improvements. Now, land does not depreciate. Why does land not depreciate? Because land depreciation is based on the asset having a defined useful life. A building lasts 30 years. Equipment lasts 5 years. Some equipment might last 10 years, depending on what it is. Land does not depreciate because land does not have a defined lifespan. In other words, the same land we have today is the same land that we had 100 years ago, 200 years ago, 300 years ago, right? So since land doesn't have a definitive lifespan, we don't depreciate land. And forget about depreciation with, again, a common mistake people make is they confuse depreciation with market value. This has nothing to do with market value. In accounting, depreciation has nothing to do with market value. All right, you have to always remember that. Depreciation is simply a matter of taking the cost of the asset and spreading it out over its useful life. Right? That's what depreciation is. Now, what's the difference between land and a land improvement? Well, land improvement is something that you would do to the land. For example, a parking lot, sidewalks, driveways, landscaping, lighting, fences, sprinklers. These things will wear out over time. These things have a defined lifespan. So we record land improvements separate from the land. Right? Because that's a thing that some people mess up. They confuse land with land improvements. Right? Just think of land as land with nothing on it. And a land improvement is something that you add to the land. And the most common one would be a parking lot. And just think the next time you're in a parking lot, think of what you see. Right? You see the parking lot, you see sidewalks, you see lights, you see landscaping, shrubs and flowers. You see those things have to be watered. You'll see a sprinkler system, etc. What about a building? Buildings could be an office, a store, a factory, a warehouse, an airplane hangar. Right? So what goes into the cost of a building? Well, the cost of the building is, again, go back to what you know about land. It's the cost of the building plus, right? Plus anything else in addition to the building. Real estate commissions are common, legal fees are common. If you need to renovate the building, let's say you bought a building that was a factory and you decide you want to use it as an office building. You buy the building because you got it for a really good price, and then you're going to gut the building and rebuild it to your specifications. New plumbing, new electrical, new walls, new everything, right? Those renovation costs are part of the cost of the building. Architect fees, permits, all part of the cost of the building. Now, what about if you were to construct a brand new building? Let's say you bought the piece of land and you did everything that you do with the land like we just talked about, and now you wanted to construct a building on that land. Well, you got architect fees to pay, you've got material costs, you've got labor to build, and you could also have something like interest cost, interest during construction. Now, normally we think of interest as an expense, but if it's interest on a construction project, any interest that was paid during the construction period gets added to the cost of the building. Once the building is completed and you move in and start to use it, any interest that you pay after that is interest expense, right? So interest is a funny one because, right, interest can be asset if it was related to the construction, but if it's after the construction, it's an expense. What about something like equipment? Well, the cost of the equipment plus anything else necessary to get it ready for use. What would be examples of that? Where we live, here's a big one, sales tax, right? If you were to buy a $20,000 car, you would pay almost $2,000 in additional sales tax. The sales tax is part of the cost of the car. If you had to have the asset shipped to you, if you had to pay any shipping, that's part of the cost of the asset. If you had to purchase insurance while the asset was being shipped to you, that's part of the cost of the asset. If you buy insurance on the asset after you have it, that's insurance expense, right? So what's the difference here? If you're paying for insurance to have the asset shipped to you, that becomes part of the cost of the asset. Any insurance you pay after the asset has been delivered to you is insurance expense. Now, sometimes the asset might come to you and you have to hire someone to put it together. Think of that furniture and stuff that you buy from IKEA, right? What a pain in the neck it is putting that together. But imagine if you had a company and you bought, I don't know, 100 desks from IKEA. And those desks have to be put together, right? What a nightmare that would be for you to do. So you hire someone to do it. The cost of the assembly would get added to the cost of the desks. Similar to assembly is installation, right? Some assets have to be installed. Maybe it's a big, heavy machine. It needs to be put on a foundation of some kind, or it needs to be secured to the floor so it doesn't flip over or whatever, right? That would be an example of installation. Testing. Sometimes before you use the asset, you have to make sure it works, and you might have to pay to have that done. Right? That's a cost of the asset. And sometimes you have legal fees. You know, when you buy what's called personal property, right? There are really two types of property. There's real property, which is like land and buildings, right? And then there's personal property, which is mostly equipment. And sometimes when you buy personal property and you have to use a loan, under the Uniform Commercial Code, the finance company wants to record that in the clerk's office to establish title, because they really own it, not you, right? If you buy something and you took out a loan, yeah, you're using it, but because there's a loan on it, you really don't own it until the loan is paid. So the finance company might file something on the county clerk's records to establish title, and you have to pay for that. Now, what about recurring costs? Recurring, things that happen all the time, every year. Property taxes, insurance. Right? Because they're recurring costs, they're expenses. Right? So they tell you here, the question to ask yourself when deciding whether to add a cost to the asset account or record it as an expense is this a cost of acquiring the asset and getting it ready for use? Or is it a recurring cost that benefits the company in the current period? Here they give you an example of Olive Garden again. They purchased new restaurant equipment for $82,000 plus $6,500 in sales tax. They had to pay freight of $800 to transport the equipment, $200 of shipping insurance. They pay $1,600 for a 1-year liability policy on the equipment in advance. The equipment was installed at a cost of $1,500. How much do we debit equipment for? The purchase price, the sales tax, the transportation fees, the shipping insurance, and the installation. Comes out to a total of $91,000. $91,000. Debit, equipment, credit, cash, accounts payable, notes payable, any combination of those. But what about this $1,600 for 1 year of liability insurance? That's prepaid insurance, isn't it? That will get recorded as prepaid insurance, and then we'll have to make our adjusting entries as the time goes by. So I think we had a homework problem that deals with that. Well, let me just mention natural resources. We're not going to really get into that. But if you're a company that depends on natural resources like oil, gas, timber, you have to account for this in a slightly different way. Instead of depreciation, we call it depletion, right? We call it depletion. But we're not going to get into it any deeper than that. All right, let's take a look. Let's take a look at one of the problems we had for homework. So this is a problem we had for homework. And again, to remind you, this comes out of the book just like it is in the book. When you do it, the numbers are going to be different, right? So here's a company. The Italian bread company purchases land as a factory site for $70,000. There's an old building on the property that was demolished, and construction began on a new building. Costs incurred during the first year are listed as follows. right? So we paid $70,000 for the land. We had to knock down the old building. There was stuff in the building we were able to sell. We had an architect fee, a legal fee, property taxes for the first year, building construction costs, interest costs related to the construction, okay? Now, determine the amounts that the company should record in the land and buildings account, and amounts to be deducted should be indicated by a minus sign. All right, so let's take a look at what we have here. We have the purchase price of $70,000. That is land. Purchase price of land, $70,000. Okay. What else do we have? Demolition of the old building. Demolition of old building was $9,000. Okay, now, sale of salvaged materials. Sale of salvaged materials is a minus 1,100. Remember, we were able to sell okay, minus 1,100. What else? Architect fees. Now, architect fees, part of building or land. Well, they tell you. Architect fees for new building. What's next? Legal fees for title investigation for the land. Well, since they're telling you it's for the land, right, it goes under land. Property taxes on land for the first year. We don't need to do anything with that now. If it were back taxes, we would have to add it to the land. But this is property taxes for the first year after we already acquired the land. That would be an expense. That would be property tax expense. They're not asking for that. We can ignore it. Building construction costs. $600,000. And interest related to the construction. Right, so that's how you would do that first problem that we had to do. Let's check the work. All right, and you can see that it came out the way it's supposed to. All right, so we together on that?
Yes, sir.
Okay. For whatever reason, some people have a lot of problems with this. But just keep in mind, is it something that happens after, then it's probably an expense. If it's something that happened before, it's an asset. Right? Before you could use this land, this is what you had to do. Before you could use this building, this is what you had to do. Okay. Okay, I just want to mention something here. We don't have any problems to do with this, but I just want to point this out to you. Expenditures after acquisition. So now you bought the thing and you started using it. And you still could have to pay for some things that are in relation to this, right? So how do we decide if any of those amounts that we have to pay should get added to the asset or should just be an expense, right? And here's the general rule. Something is an expense if it benefits only the current period. So think of something like maintenance. When you buy a car, you know you're going to have to get oil changes regularly, right? That's an expense. That's maintenance expense. You know when you buy a car that sooner or later you're going to have to replace the brakes. That's maintenance. That's an expense. So things like what did I say? Oil changes, brakes, tires, I don't know, shock absorbers. Does anybody replace shock absorbers in cars anymore? I know they used to, right? These are all things that wear out just in the regular use of having a car. But if you have to pay for something that increases future benefits, now what does increased future benefits mean? It means that it might make the car better to use, or it could extend the life. So let's say, for example, you bought a new car and you liked it and it worked fine, and you had the car for like 3 years. You intended to keep it for 5. And sometime during the 3rd year, you had to put a new transmission in the car. Do you expect to replace a transmission in a car? No, not really, right? I mean, I've owned dozens of cars in my life, and I don't think I've ever replaced a transmission in a car. That's something you would not expect. That's not a normal maintenance item like an oil change is. So if you decided that you were going to put a new transmission in that car, you might decide to keep that car for a year or 2 longer than you originally intended. That type of expenditure increases the asset. So when we say the word capitalize, we mean we're going to add to the cost of the asset. What if, let's say, for example, you bought a car without air conditioning. I don't know if you can do that. I think all cars come with air conditioning these days, right? But there was a time when they didn't. So let's say you bought a car without air conditioning and you decided after going through one summer of sweating your brains out that you wanted to install an air conditioner in the car. The cost of installing the air conditioner isn't a routine maintenance item. It's something that adds to the benefit of that car, right? That car now is a better car than it was before. That cost would be capitalized, right? So you have to say to yourself, is this just a routine item? Is this something that happens all the time? You know, I have to change the oil in the car every 3 months. I have to change the brakes every 2 or 3 years. I have to get the engine tuned up maybe once every 3 or 4 years. I expect that. I don't expect to replace the engine. That cost gets added to the asset. I don't expect to replace the transmission. That cost would get added to the asset. I don't, when I bought the car without air conditioning, I thought I could get by without it. I had to put air conditioning in the car. That could have cost me a couple $1,000s to do something like that. That cost gets added to the asset. So here they go through a whole explanation of that: repairs and maintenance, additions, improvements. Don't get bogged down in it. I'm just bringing it to your attention. Okay. Here's our next major topic, cost allocation, which is another way of saying depreciation. And remember, what does depreciation mean in accounting? It means taking the cost of the asset and allocating it to expense over time, right? In other words, we take the cost of the asset. Let's say we paid $10,000 for a machine, and we say, okay, how long are we going to use it? 5 years. How much depreciation do we have every year by owning that asset? That's what depreciation means, right? It's allocating the cost of an asset to expense over its service life. Right? There's the definition. So here they show you, we take the asset, we record it at cost, and then over its life, 1, 2, 3, 4 time periods in this case, we divide that cost up and record depreciation expense during each time period. Remember, debit depreciation expense, credit accumulated depreciation. Depreciation is an expense, belongs on the income statement. Accumulated depreciation was a contra asset, if you remember. It's used to show a reduction in the cost of the asset. Depreciation in accounting is not a valuation process, has nothing to do with market values. So here's an example. Assume that Starbucks pays $1,200 for equipment and they expect to use the equipment over a 4-year period. Service life is 4 years. How much would depreciation be? 1,200 divided by 4 is $300 a year. Debit depreciation expense, credit accumulated depreciation. And notice when you look at the accounting equation, the left side of the equation decreases $300. The asset decreases $300, right? The asset equipment is decreasing $300 through its accumulated depreciation contra account. And on the right-hand side of the equation, what's decreasing? Well, stockholders' equity is decreasing, right? Remember, stockholders' equity was made up of common stock and retained earnings. Retained earnings was made up of revenues, expenses, and dividends. And when you record an expense, it reduces stockholders' equity. So that's why you see the minus sign there. How would you show this on the balance sheet? You would say, okay, I have this equipment. I paid $1,200 for it. It's wearing out after the first year. $300 have worn out. And that's how you should think of depreciation. The asset is wearing out, right? When you buy something brand new, a year from now, it's worn out a little bit, hasn't it? So it's not that it's not worth as much in a market value sense. It's not worth as much because now it has less utility to you. Just think of the new computer when you first buy it. It's so fast. You click, click, click. The thing just goes from screen to screen to screen. After a year, doesn't it slow down a little bit? After 2 years, doesn't it slow down a little bit more? By the end of 5 years, right, you're cursing at the thing every time you go to use it because it's so slow. It's wearing out. It's no longer as good as it was when you first got it. Depreciation means wearing out. Doesn't work as well. This would be after 2 years. I paid $1,200 for the equipment. It's worn out. $300 the first year, $300 the second year, total $600. What's the value of that now? $600. Book value, right? Book value, $600. And so on. Right. Now, to record depreciation or to calculate depreciation, we have to take 3 factors into effect, 4 actually, right? The first one, they just assume that you know the cost, right? How much did you pay to acquire the asset? And by acquire the asset, I mean do the things that we said earlier today, right? The purchase price, the sales tax, the shipping, etc., all of those things. So you need to know that first. What else do you need to know? You need to know the service life. How long does the company intend to use this asset before disposing of it, right? That's what the service life, or sometimes it's called useful life. Residual value. Residual value. Do we think that this asset will be worth anything at the end of its useful life? We estimate it. Maybe we base it on the last time we had the same asset. Or maybe we just make an assumption. Or maybe we go to the place where we bought it and say, do you have any used ones of these things? How much do they cost, right? And you could use that as your residual value. Sometimes it's called salvage value. This is important because you can't depreciate any amount that you think you're going to get back. And then finally, the last thing you need to know is the depreciation method. We are going to learn 3 different methods. The first one is the simplest one. It's called straight line. It's like the example we just saw here with Starbucks. Right? We took the $1,200 asset and we divided it by 4 years. That came out to $300 a year, right? That's called straight line. There's another method that's similar to straight line, but instead of looking at years, see, when we do straight line, we're trying to figure out how much is depreciation each year. And it'll be the same amount each year. This method is by far the simplest and most commonly used. Activity-based says, well, wait a minute. The more I use an asset, the more it depreciates. So if I had a car, for example, and one year I drove the car 30,000 miles, that car would depreciate more than another year where I only drove the car 10,000 miles. So we use this activity method when we want to base depreciation on some unit of activity, like miles driven or how many hours a machine is used, right? Well, it's not as complicated as it sounds, believe me. And the last method is called declining balance, which makes no sense. What do I mean by that? It means that the depreciation is a lot more the first few years you have it and less the last few years, right? Now, again, does that make sense at all? Well, maybe not, but just think of this. What if you were to buy a brand new car today? And you go to the dealer and you pick it up and you're all excited and you pay whatever it costs. Let's say it costs $30,000. And you get the car home and you're looking at it and you're in the house and maybe you're just laying there looking at the ceiling and just saying, geez, you know, that was a lot of money to pay for a car. I'm going to bring it back and try to get my money back for it. And you drive the car back to the dealership and you say to the dealer, you know, I changed my mind. I really don't want this anymore. What do you think the dealer is going to say? Well, when the dealer is finished laughing, the dealer is going to say, okay, we'll take the car back, but we're going to have to buy it back from you, say, for $25,000. And you say, well, wait a minute. I just drove this car home a few hours ago. I paid you $30,000. It's only a few hours later. How do you get 25? And the dealer will say, well, it's a used car now. I can't sell this as a new car anymore. That's what this kind of thing assumes, that some assets depreciate really fast the first few years and a lot less the last few years. Right? So we'll see how to do that. Okay, so let's look at the example they give us. This is a company that sells sandwiches, Little King sandwiches, and they purchased a new truck. And here are the details on the truck. They paid $40,000 for the truck, right? And that assumes what? That has all the sales taxes and everything else in it. So the cost of the truck is $40,000. We estimate that that truck will be worth $5,000 when we're finished with it. When are we going to be finished with it? In 5 years or 100,000 miles. Now, for straight line, we'll use 5 years. For declining balance, we'll use 5 years. If we're going to use an activity method, we'll base it on 100,000 miles. So under straight line, how do we calculate depreciation? Right here. We take the cost of the asset minus the residual and divide it by the service life. Asset cost minus residual is called depreciable cost, right? Depreciable cost is the original cost minus the residual value. If I take the depreciable cost and divide it by the service life, that's the annual depreciation expense. So 40,000 minus 5,000 is 35,000. 35,000 divided by 5 years is $7,000 a year. Debit depreciation expense, credit accumulated depreciation, $7,000 each year. Each year. Now, sometimes you'll see this expressed as a percentage. So the 5 years, we say that this asset depreciates 1/5 each year. 1/5 is equal to 20%. So we may see it that way at some point. Okay, now here's a depreciation schedule. We have a column for each year. We have a column for depreciable cost, right? 40,000 minus 5 is 35. We have a column for the rate, the depreciation rate. And I'm sorry the way this kind of runs into each other. Let's see, is there a way I can clear this? Not really. So the depreciation rate is 20% a year. 1/5 is 20%. And if I multiply 35,000 times 20%, I get $7,000. Each year, the depreciation is the same. 7,000 year 1, 7,000 year 2, 7,000 year 3, and so on. This column is the accumulated depreciation. So what's the accumulated depreciation? It increases each year by $7,000. So after the first year, it's 7. After the second year, it's 14. After the third year, it's 21. After the fourth year, it's 28, right? I just keep adding 7,000 to it. After the fifth year, it's 35,000. So notice that if I total up all the depreciation expense, 35,000, it comes out to be what this number is here, 35,000, right? Cumulated depreciation starts out at 0, and each year it increases by 7,000. What's the book value? And this is where people make mistakes. The book value is the original cost. The original cost was $40,000 minus accumulated depreciation. $40,000 minus $7,000, $33,000. $40,000 minus $14,000, $26,000. $40,000 minus $21,000, $19,000. $40,000 minus $28,000, $12,000. $40,000 minus $35,000 is $5,000. Does that $5,000 look familiar to you? That $5,000 is the residual value. If you remember, if you go back to the beginning of the problem and it told you original cost 40, residual 5. So you cannot depreciate below this 5,000. Right? Some people try to make it come out to be 0, and it could only be 0 if the asset had no residual value. If there's a residual value, it has to be whatever the residual value is. Another way to look at it, if you take the book value at the end and add the accumulated depreciation, it should come out to the original cost. 5 plus 35 is 40. That's straight line. Let's look at activity-based next. We could depreciate this by the year, right? Or we could depreciate this by the mile. So that's what activity-based is. Under activity-based, we're going to, in this case, we're going to use miles. Very similar calculation. We take the original cost minus the salvage, that's depreciable cost, divided by total units expected to be produced. In this case, it's 100,000 miles. So if I take 40,000 minus 5,000, that's 35,000. 35,000 divided by 100,000 is 35 cents a mile. 35 cents a mile. Now I need to know how many miles were driven each year, and then multiply that by 35 cents. So they tell you down here, the actual miles driven in years 1 to 5 were 30,000, 22,000, 15,000, 20,000, and 13,000. Now you should add those up to see if it comes out to be 100,000. Right, and it should. The way this book does things, they don't try to trick you. When I was a student, they try to trick you and they make it come out to be more than 100,000. The thing to remember is you stop at 100,000. Even if you actually drove more, you stop at 100,000. So here's what it would look like for each year. Years 1, 2, 3, 4, 5. These are the miles driven each year. They just told you that here, right? They just told you that. Miles years driven 1 to 5. Write down the miles driven, multiply by 35 cents. That's your depreciation expense. Notice it's different each year. The more miles you drive, the more the depreciation is. What's the accumulated depreciation? It's last year's depreciation plus this year's, right? So we start out at 0. We add 10,500 the first year. 10,500 plus 7,700 is 18,200. 18,200 plus 5,250 is 23,450, right? And eventually you have to wind up with this 35,000, just like we did before. Regardless of which method you use, you have to wind up in the same place. And by that I mean, the most you can depreciate, regardless of which method you use, the most you can depreciate is the original cost minus the salvage value. What's the book value? Again, they messed this up here a little bit. It's the original cost. It's the original cost minus the accumulated depreciation, right? So in your book, I'm sure you can see this. For some reason, this gets cut off here. The original cost minus accumulated depreciation, right? And notice you wind up at salvage value again. Here you wind up at 35,000. If you were to add the 5 years together, it adds up to 35,000. And here you have to wind up with 5,000. And 5,000 plus 35 takes you back to your original 40. That's this activity-based method. Right, let's take a look at this declining balance method. Now, the declining balance method, they say it's an accelerated method. What does that mean? It means that you have more depreciation expense in the beginning and less at the end. However, you will wind up in the same place. In other words, what's the most you can depreciate on this asset? 40,000 minus 5,000 is 35,000. Doesn't matter which method you use, the most you can depreciate over the 5 years is $35,000. Okay, so let's take a look at this method. Under this method, we are going to assume that depreciation occurs at a rate twice as much as straight line. Therefore, we call this double declining balance. What does the word double mean? Double straight line. Straight line was 1/5. 1/5 is 20%. Double that is 40%. So the depreciation rate is 40%, right? That's where you see this number here, 40%. Okay. Notice depreciation expense is different every year. But notice that it adds up to 35,000 just like before. This number has to be 35,000. This number has to be 5,000. So regardless of which method you choose, you wind up in the same place. That's why most companies just use straight line. It's the easiest method. It's the hardest to make a mistake. And since you wind up in the same place anyway, why bother with some of these other things? But you may use a method like this for tax purposes because you get a bigger depreciation deduction in the first few years. Now remember, under straight line, depreciation was $7,000 each year, right? If you remember. Look what it is here. It's 16. So would you rather have a $7,000 tax deduction or a $16,000 tax deduction? Most people would rather have the $16,000 tax deduction, right? But it doesn't really matter that much because over the 5 years, it still comes out to 35. Notice how this works. Again, you have a column for year. You have a column for book value, right? Not depreciable cost, book value. So what's the book value when you begin? The book value when you begin is the original cost. The original cost was 40,000. Times 40%, 16,000. Accumulated depreciation, 16,000. What's the book value? 40 minus 16 is 24. That 24,000 becomes your new beginning. 24,000 times 40%, 9,600. What's accumulated depreciation? 16,000 plus 9,600 is 25,600. What's book value? 40,000 minus 25,600 is 14,400. That becomes the new book value, year 3. 14,400 times 40%, 5,760. What's the accumulated depreciation? Well, you could add the 3 years together. Comes to 31,360. What's the book value? 40,000 minus 31,360 is 8640. 8640 becomes the new book value times 40%, 3,456. What's the accumulated depreciation? I add the first 4 years together, comes to 34,816. What's the book value? 40,000 minus 34,816 is 5184. Okay? Now, sit back. Relax a minute. Close your eyes. Think of something enjoyable you're going to do later today. Okay, now open your eyes. How much does the last year's depreciation have to be? Now, again, if you're a robot, you would take the 5184 and multiply it by 40%, right? Because that's what you did the first 4 years. But remember where you have to wind up. You have to wind up, this column has to wind up at 5,000. Right now, it's 5184. So how much does depreciation have to be the last year? The difference between these two, 184. See it? 184. Another way to look at it is, well, how much do I need to go from 34,816 to 35,000? I know I have to wind up at 35,000. Right now, I'm at 34,816. How much more do I need to wind up there? 184. Another way to look at it is to say, I know this column has to add up to 35,000. What number do I have to add to this column to make it add up to 35,000? So whichever way you're comfortable seeing it, right, doesn't matter. To me, this is the easiest thing to see because this number you calculated, this number you know you have to wind up with, what's the difference between these two? It's 184, right? And then when you add 184 to this column, it comes out to 35,000. If you add 184 to this 34,816, it comes out to 35,000, right? So it doesn't matter how you interpret it, as long as you come out to the 184. So now you see why this method isn't used that much? Because it's really easy to mess this up. So you follow the formula religiously for the first 4 years, but the last one, you kind of abandon it and you massage it to come out the way you want it to come out. And here they compare the 3 methods. So no matter which method you use, where do you wind up? You wind up at 35,000. It's just a matter of how you want to get there. How many companies use straight line? 92%. How many use the activity-based? 3%. How many use declining balance? 4%. Right, and there are other methods too, by the way, that we don't talk about. Why do so many companies use the straight line? It's just easier to use, right? It's the easiest method to apply. Here's another example where I won't go over it with you, but you might want to. I just want to go to the next topic. Asset disposition, sale, retirement, or exchange. What happens when we get down to the end of the life of the asset and we decide to dispose of it? There are three things that could happen. I could sell it. I could trade it in for a new one. You know, you trade in the old car for a new one. Or I just say, you know what? I'm just going to get rid of it. Now, when you have a sale, that means cash is being received. Right? So you're going to make a journal entry to record the cash that you received and remove the old asset from the accounting records. Now, what I need to do is I need to look at what I have in the asset account, and I also need to look at what's in the accumulated depreciation account, because if I'm going to get rid of the asset, I have to also get rid of the accumulated depreciation. What I also need to do is to look at the book value of the asset when I sell it to determine if I had a gain or a loss. Compute the book value, original cost minus accumulated depreciation. Compare that to the cash received. If the cash received is more than the book value, you have a gain, right? That's what they say here. A gain occurs when we sell the asset for more than book value. If I sell the asset for less than book value, that means I had a loss. So here's that example again for the Little King's sandwich shop. The original cost of the truck was $40,000. The residual is $5,000. The service life is 5 years. The depreciation a year under straight line is $7,000. If we assume that they sold the truck at the end of year 3 for $22,000, what would happen? What would happen? Well, we know we would debit cash for $22,000. We know that we would credit equipment for $40,000. What's the accumulated depreciation after 3 years? 7 times 3 is 21. I would debit accumulated depreciation for 21. What's the book value after 3 years? 40,000 minus 21 is 19. So if the book value is 19 and I'm selling it for 22, that means I had a gain of 3, right? So you see it here. The sales amount is 22. The original cost of the truck was 40. The accumulated depreciation was 21, means the book value was 19. 22 minus 19 is 3. What journal entry gets made? Debit cash for 22. Debit accumulated depreciation for 21. Credit equipment for 40. And credit gain for 3. So think about what this entry does, right? Because again, some people get really messed up and confused with this. Think about what you're doing. You're recording the cash that you received, $22,000, debit cash, right? How many transactions have you debited cash for, right, over this semester? Dozens, right? Somebody hands you a check for $22,000, you have to debit cash for $22,000. You're selling the equipment. You're not going to have the equipment anymore. The equipment account is for $40,000. If you're not going to have the equipment anymore, it means the asset decreases. You decrease assets with credits, right? Credit equipment for 40. So debit cash for 22, credit equipment for 40. Now, if you don't have the equipment anymore, that means you're not going to have the accumulated depreciation anymore. The accumulated depreciation was $7,000 a year times 3 years, 21. Debit accumulated depreciation. Now, why do you debit accumulated depreciation? Because accumulated depreciation has a credit balance and you want to make it zero, right? It had a credit balance of 21. By debiting it for 21, you wipe out the accumulated depreciation account. So what are you left with? You've got debits of 22 and 21, which is 43, and you've got a credit of 40. Debits of 43, credits of 40, you need $3,000 for the entry to balance. Remember, debits have to equal the credits every time you make an entry. What is that $3,000 going to be? Gain, right? So even if you don't want to calculate the gain like we did here, you really don't have to if you got these other numbers right. Now, what if they sold the truck for $17,000 instead of 22? 17 instead of 22. What's the book value? The book value is still 19, right? 40 minus 21. So if I sold it for 17 when the book value was 19, that means I had a loss of 2. So how would the entry be different? I would debit cash for 17 now. I'm still going to debit accumulated depreciation for 21. And I'm still going to credit the equipment for 40. So 17 plus 21 is 38, debits of 38, credits of 40. I need a debit of 2 to make the entry balance, right? And that 2 is a loss. So gains are credits, losses are debits. If you don't like this, calculating this, you really don't have to if you got the rest of this right. You can figure out what this 2 is. Now, what if you decided just to not sell it? Let's say it was in beat up, bad shape, and you really don't want to spend any money fixing it. Or maybe, you're not doing the same amount of business you were doing before, so now you got this machine you don't need. So I just decide to throw it away. That means I sold it for 0. So if the book value is 19,000 and I didn't get anything for it, that means I have a loss of 19,000. So what entry would you make? Debit accumulated depreciation. Again, it's the same 21,000, 7,000 a year times 3 years, 21,000. Debit loss 19, credit equipment 40. Right? This assumes that I just got rid of it. They give you the example, the thing was in an accident and it didn't have insurance, so you didn't want to bother figuring it out. I'm not going to do trade-ins, a little too complicated, not required of us. Okay. So let's look at the homework, what's left. So we did the first one here. Right, the second one is depreciation problem, University Car Wash. They paid $270,000 for these new car wash machines, and they have a residual value of 24. They estimate they'll use the machine for 6 years or 12,000 total hours. These are the hours per year. Right. Under straight line, what would it look like? Right. I'm just showing you this now. I'm going to go over it with you next week. Now, when you do the problem on Connect, you just have this. You have to put numbers in boxes, right? So you may need to, when you actually do the problem, do it like we did it in the book. This is what it looked like in the book. Declining balance method. And remember, declining balance method, that last year is funky, the way you come up with the number, right? And activity-based, we have to figure out how much per hour. The depreciation rate came out to $20.50 an hour. Right, and then we multiply by the number of hours the machine was used each year. Right, and that's it for your homework. I threw another problem in here on disposal of asset. You won't have it for homework, but I'll go over it with you next week because I'm not sure there might be an exam question on that. So I want to cover it with you just in case. All right, so we're finished for today. Does anybody have anything they want to add?
I just wanted to ask a quick question.
Yes.
Can you hear me?
Yes, I can.
Oh, I'm sorry. The exam was on chapter 5 and 6 that is due to today?
Yes.
Okay. Thank you. I just wanted to check.
Anything else? So if that's it, I think we can break. Enjoy your Thanksgiving, but don't start enjoying it until you finish the exam, right? Make sure you get that done today. And I will see you next week. We'll finish the homework here in 7, and we'll start 8. All right, is everybody okay with that?
All right. Thank you so much, Professor. Happy Thanksgiving.
Have a good Thanksgiving.
Same to you.